My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, and put days like today in context. Call me, 1-800-743-CNBC. Tweet me, @Jim Cramer. All right, we got a nasty sell-off today, all right? The Dow lost 268 points. S&P declined 0.86%, probably most important. NASDAQ fell 1.12%. Yep, the worst hit, tech, especially the cloud plays that were roaring higher not that long ago. They were crushed. And the worst part, I don't think that the selling is over. Sell, 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 sell. Yep, anything that helps enterprises harness the power of the cloud had been on fire coming into today's session, along with anything related to streaming content. And that's because of the wildly successful Disney Plus, that new over-the-top service. They've been the big winners for several weeks, ever since NVIDIA and Splunk reported great quarters. Now, though, the whole complex is selling off relentlessly, including the stock of NVIDIA itself. What's driving this newfound weakness, and how long will it last? Isn't that what you want to know? Well, I'm going to walk you through all the reasons so you know what's ahead. First, it's the beginning of a new month, all right? And you know what? In almost every new month, especially after a very big run, we get a period where large funds decide to take something off the table. It's not a dumb idea. Given that no one was expecting this kind of selling, witness the clueless pajama traders as of last night and this morning who were still buying. You have to be wary. You know, it's hard to find the other side of the trade when you're selling. There's so many ETFs that contain these cloud names that it's possible for one or two of them to bring down the whole group. It's ridiculous. It is the tail wagging the dog. But it happens. We've seen it regularly since the software as a service meltdown in April of 2014. Now, you have to be careful because these kinds of moves can be brutal. And more important, they can be longer lasting than the typical dip. You dip buyers focus. In 2014, the whole group got hammered, led by Salesforce, which plunged from $67 to $48. Given that Salesforce reports tomorrow, I recommend proceeding with caution. You know I love this company. And ordinarily, I like it when a stock pulls back going into earnings. My first instinct is to say the bar's now gotten lowered. It's been de-risked. But now I worry that it may be rolling over along with the whole cloud cohort, regardless of how well it's doing. And that worries me, even though, again, I'm a big fan of Salesforce. And it is a key position for my charitable trust for a long time. And you can follow along by joining the ActionAlertsPlus.com club, where I'm going to overwhelm you with bulletins just about this situation. Look, the stock of Salesforce has experienced 4 major declines since 2014. 4. You know, and not one of them ended in a day. They were all multi-day or even multi-week shellackings, including the one we saw earlier this year. If you're nimble enough to be a trader, then I actually would lighten up here and then buy it back at a lower level. But for most people, that's a bad piece of advice. I think you should stick with it through the pain, because you never know if you'll be fast enough to actually get back in a better price. Now, the story here is still fantastic. Take a look at print out the story from 2008 to here, and you'll see. You won't even be able to see declines like the one I'm talking about. We just checked in with Salesforce at the big Dreamforce conference 2 weeks ago, and they told an incredible story, but that won't protect the short-term turbulence. Again, it may not. I'm just concerned. I'm concerned because this cloud sell-off looks like the real deal. Remember, it's not the ETF-driven selling, not that it's so heavy. It's that the buying is so thin. Think of ETF selling as being like a machine gun, while single stock buying is more like a bolt-action rifle. The guy with the rifle simply doesn't stand a chance until the machine guns run out of ammo. Typically, that takes 2 or 3 days for the stocks to get low enough that the selling dries up, and it could be like that. There'll be some stocks that will hit a bottom 3 days from now, but I'm just concerned for you. Second negative catalyst. Did you see the stock of Roku today? Now, here's a company that's become the face of cord cutting. Roku's technology lets you stream video over the internet directly to your television. They make it easy to watch something like that Disney Plus I mentioned on a big screen. It's the best way to get your Baby Yoda fix. Now, Roku's been downgraded many times before in the last 3 months. But you know where the stock was always able to bounce back, even intraday, until today, when Morgan Stanley downgraded to a sell. heresy. They called the recent rally unsustainable. And that call resonated, which is why that stock plummeted 15% today. When a stock that's withstood endless assaults gets pulverized by a sell recommendation, well, that's a sign of what I call overextension. Some traders believe Roku's the key to this market, believe it or not, meaning they take their cue from the action in this one, and it actually was the proximate cause of today's vicious decline. Third negative catalyst, oh boy, I know you're sick of it, but it's China. Typically, the cloud and streaming stocks don't really react to news about the trade war, but today was an exception. Going into the weekend, there was a widespread belief that we would have a phase one trade deal with the Chinese locked down, a deal that might have opened up their markets to some of our software companies. When the Chinese government said that there need to be some rollbacks of the tariffs, though, before we can have serious talks, well, this was taken as a sign that, frankly, they don't care about it anymore. That's right. They don't care about making a deal. Is that true? My understanding is that until President Trump signed this Hong Kong bill, which imposes sanctions on Chinese officials who are responsible for human rights abuses, we basically had a workable deal to stave off the upcoming December trade hikes. Then the Hong Kong bill threw everything out of whack. You might think this has nothing to do with the trade war, but the Chinese view it as an escalation. Now they want the tariffs rolled back, and I think that's very unlikely. Not when the president's actually increasing steel tariffs on Argentina and Brazil, ostensibly because of currency weakness, but really, I think, to prevent them from buying cheap subsidized steel from China and then dumping it here, which is why that was so significant. And that's why the market went down after starting to head up. My guess, the Chinese would rather take their chances and wait for the election next year. If they, in hope that they get a more amenable president like Joe Biden, who's more of a globalist than Trump, I think they're making a mistake. They could just as easily get 4 more years of Trump. Or someone even tougher on China, like Warren, Elizabeth Warren, because she's had it with the Chinese despoiling the earth. And no tariff gets rid of that. Once China's in play, we have the usual tech suspects selling off. NVIDIA, we know it needs to close on the Mellanox acquisition to raise numbers. Chinese are blocking it so far. Apple needs the trade talks to go smoothly so they don't get caught in the crossfire. Doesn't really matter about all that with the AirPods. Well, how about that story? The financial technology companies, well, they're all hoping they're going to get a crack at the Chinese market. Of course, China hurt more than just tech. This was a market-wide problem. Boeing seemed to trade in lockstep with the trade talks. And as we get closer to the end of the year, I'm starting to wonder there'll be plenty of people who are thinking, wait a second, how the heck can this company make good on all the payments the airlines are asking for as reparations for the 737 MAX fiasco? Remember, I had Southwest Air on a squawk on the street. They said they owe money. We had American owe money. The stock got hit hard today. I think the Boeing stock may actually be in a rollover phase. My advice. These squalls of selling take multiple days to work through the system. You almost never just get one day. I think the people who are simply taking profits to lock in their gains have too many winners to finish trimming the positions in just one session. The pattern of Salesforce and the other cloud kings is to get hit for at least 3 days, if not longer. I'm betting President Trump's tariff hikes go into effect on December 15th now, which won't be good for the stock market. At the end of the day, we got too complacent. Once we made it through the always tough month of October, investors sometimes get a little giddy, assuming they have nothing left to worry about. The Fed's on the right track. We seem to be on the cusp of a trade deal. We had good quarters from Splunk and NVIDIA. That allowed the entire cloud cohort to go higher. And it was too good to be true, people. We needed and need a shakeout. We needed some sellers to instill a reasonable amount of fear and worry. I think we're on our way there. Bottom line. We got hammered today, okay? And it was much more of a hammering than even the averages look like because there's not enough negativity. Once people start worrying again, stocks will come down to more reasonable levels, and then you can pounce. Buy, buy, buy! But we're not there yet. And I don't think you should jump the gun. Richard in New York. Richard!
Hey, Jim, how you doing?
I'm good, Richard. How about you?
Good. My question today is Warren Buffett maintains a significant capital stake in Occidental in spite of its debt-laden balance sheet. Buffett received very favorable terms for this capital infusion. While it's a good business deal for Buffett, can this stake change the downward trend of the stock, or is the debt exposure just too great?
Well, I think he has first dibs. I think they paid too much, Oxy, but I do think that the company's got the cash flow. I just don't like the stock. And I don't like how they took that deal from Buffett rather than just go to a bank. They might defend that, but there's too many people I talk to in banking who find it too hard to defend. Let's go to Stephen in Tennessee. Stephen.
Booyaka shot from East Nashville. Hey, Jimmy, we're looking at record-setting Black Friday spending numbers, especially for e-commerce, Cyber Monday. I'm looking at a company that says they already provide e-commerce solutions for a whole bunch of S&P 500 companies. $700 million recent sale of assets, low PE, big short interest, insider buying. Jimbo, set me straight. Is this just a budget stocking stuffer for my portfolio, or is this the Christmas present that sends my kids to Vanderbilt? What do you think of Pitney Bowes?
Wow, you actually thought of it longer than I would have. I think this is a stock that many people have tried to catch the bottom in. Do I look like a butcher block to you? I mean, I did some cooking on Thursday, but I would never let those knives near me, and I wouldn't let the knives near, I would fear PPI. A couple things, president tweeting again, Fed's got to move because of the stronger dollar, totally unhelpful. We got Coupa reporting, it's right in the cloud group. It was a great quarter, it's getting hit. My negative theory is playing out here. All right, today's sell-off was prompted by too much complacency. I think we're in an early days of a much-needed shakeout. On Mad Money tonight, I'm eyeing two stealth stocks that you may have missed. I'll tell you the names and why they're soaring. Then, what's the fear index signaling going into 2020? I'm going off the charts to find out. You're not going to like it. And the security software space is chock full of sexy new names that you can use to play the secular trend. I'm eyeing one old standby that I've liked for a long time. Don't miss my exclusive with CyberArk. And stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.